because I was in the wrong place and then I fell down the stairs. It's like, so be careful with those. Hi, everybody. Thanks for joining us. I think we're going to give people, we've got a bunch of people rolling in here today. I think we're going to give people just a little bit of time to get going. You have joined the latest in mortgage today, and it's Friday, and it's Super Bowl weekend, and it's the Olympics. So, like, as we're getting going here, pop in the chat your favorite Winter Olympics activity. And Angie's got to go Seahawks in there. So you can put that in the chat too. If you want to, who you're rooting for the Super Bowl or what your favorite activity in the Winter Olympics is. You'd think I'd be a hockey fan too, being in Minnesota and all, but women's ice hockey. Oh, Susan, good one. Snowboarding. What else we got? Sarah, what's your favorite Winter Olympics?
Oh God. Probably gymnastics.
Yeah.
I don't
I'm
know. That's a
I'm
that's a winter sport, isn't it? And it doesn't that come on in the winter? Or is that the summer?
That's the summer. I think that's the summer now that I think about it.
Maybe just the
Oh yeah.
NCAA stuff is going on right now and I'm getting it confused with the Olympics. All right, if I had to choose a winter one, I don't know. Maybe like the down um where they
Downhill ski.
they go down, they launch off the thing and they do all the flips
Oh,
or because it's kind of like gymnastics a little bit.
yeah. The lift, I don't remember what somebody tell us what that's called. I don't remember what that's called where they fly through the air. The Park
They do like all the
City
twisty
thing.
turnies and they have
Yeah,
to land it.
yeah, yeah. Mine is speed skating. I don't know why, but it is either that or oh my gosh. I'm losing it. Curling. Yes, Ryan, thank you. Curling. You knew what I was thinking. Big deal here. Big deal here in Minnesota. So,
I
yeah,
like Ashley's answer too. I like the figure skating. That's
yeah.
nice.
Good. We got a wide variety and a lot of people in here. Keep participating like that as we talk through things. So, this is, of course, the latest in mortgage today. I have with me the most beautiful, esteemed co-host, Sarah Gonzalez, who's the Chief Innovation Officer at Logan Finance. Thank you, thank you, thank you for doing this with me today. It's
I'll
lovely
give you
to
a
see
hundred bucks later, all right? Don't let me forget.
Yeah, so for those of you who are just joining us and maybe haven't been here before, in each episode of the latest in mortgage today, we have a TMC lender member joins us to help us unpack what's new in mortgage, what's working, what's shifting, and kind of what it means for all of us. The goal is to build a space where we all can show up, speak out, and make meaningful contributions. So keep a chatting away in the chat on anything that we're talking about or anything that you would like to share or ask us. Sarah, you want to introduce a little bit so that people kind of level set with who Logan Finance is?
Sure. Again, my name is Sarah Gonzalez. I'm the Chief Innovation Officer at Logan Finance. We are headquartered out of Hauppauge, New York, but we also have an office here in the Dallas-Fort Worth area in Plano, Texas. I am a Texas native, so I live here, work here. Obviously, I see a lot of you around and about, but this is my home base, and luckily we have an office here. Logan's been in business over 75 years and recently went through a transition about 4 or 5 years ago where our parent company, Newberger Berman, based out of Chicago, took on the firm and flipped it from a GSC, really heavy government shop into a 100% non-QM shop. So prior to that transition, a fun fact is we were actually Fannie Mae's first ticket that was ever issued. So Fannie Mae's
Wow.
first ticket that they ever issued was to Logan Finance. And then we had a big part in providing our veterans loans as they were coming back from Vietnam War. So that's another fun fact. But fast forward to where we are now, and just after the COVID debacle, we started working on non-QM and we've been doing that ever since. We do have a primary focus in wholesale and correspondent, both Dell and non-Dell. We are focused on credit quality, which I know we're going to kick off this entire conversation with credit, but there's been lots of things that have flown through the air over the last 10 years about non-QM, some of which is just fake news, and some of it of which is not fake news. But we're a high credit quality box. 660 is our minimum pretty much, and we're looking to make good deals with make sense credit decisions. So I'm happy to be here. I've been here for 2 years, actually. Next week will be my 2 year anniversary. And I actually started as their COO and transitioned into this Chief Innovation Officer role, which I'll get into as we get into the conversation today.
Yeah, yeah. It seems impossible that you've been there 2 years already.
I know.
That flew by. Congratulations to you on your
Thank
work
you.
anniversary. Yeah. We are going to talk about credit standards and kind of what's going on in lending. Um, every article that I've read say they remain relatively tight compared to what they were in, pre-pandemic. You mentioned the pandemic. But I feel like we're seeing more lender members that are beginning to introduce different products into their product mix. And those are things like down payment assistance programs, first time homebuyer initiatives, non-QM. And so I wanted to talk with you a little bit about that. And from the seat that you sit in, are you seeing any like loosening of underwriting standards, or do you feel like lenders are still being very, very conservative in their lending?
I mean, in a wholesale or really in a TPO environment, right? I'm dealing with a lot of different kinds of customers, right? From the most
Right.
sophisticated customers to ones that are just getting started and wanting to get into the business and trying to find their way because we've seen a lot of retail shops flip into wholesale shops because it's more cost effective, right?
Right.
And so when you're dealing in situations like that, you kind of lose control of your credit box a little bit in the TPO space, because you're at the behest of the wholesale lender or the correspondent lender or investor guidelines that you're selling to. So, have I seen other lenders talk about, credit expansion? I mean, I'm on calls all the time where I think it depends on your risk appetite and what you're willing to do and whether or not you have the outlet. But what I can say is over the last 2 years, there's been a lot more of discussion around the non-QM market and getting into those private sale agreements because of just some of the uncertainty and DC around our GSE platforms and mainly around that. I know, we had the longest government shutdown ever, last year. So, I do think as the market shifts, that I do think people are more interested in looking at other programs, um, and what's going to accommodate some of these programs because let's face it, while the GSEs have been really good to us in a lot of ways, they are a box, right? And if you don't fit in the box, you don't fit in the box. And so companies like Logan, like where I work, we are able to get super creative on what we want to put out there. And I'm probably not supposed to say this, so you'll be the first to hear, but we're launching 3 new products in the next couple of weeks that
Oh,
give borrowers options to go up to 5 million in loan amounts. So those are really cool things that I'm kind of letting the cat out of the bag a little bit here. So we haven't told anybody, but my TMC family I love so much that we're gonna go ahead and get that out. But I do think that like non-QM offers a lot more flexibility. Of course, your first time home buyer programs and things like that. Again, some of those options are already embedded within non-QM guidelines because we're not accepting DPA programs through that. But it doesn't mean that in a retail environment you can't somehow put those things together. But there's a lot of warehouse constraints and things like that that go along with those things as well. So, but yeah, I mean, I think overall, I think people are wanting to accommodate different situations. I mean, we're going to talk a little bit later today about housing affordability. What you could be in the same house for 10 years and what you could afford 10 years ago, surprisingly, you should be making more money in theory and be able to afford it more. And there's some cases where we're not seeing that, where people have lost the ability to afford the home, maybe not because of the mortgage payment, but for other reasons. Um, so anyway,
We we will
yeah,
be talking about we'll be talking about a few of those. Yeah. Are you seeing, I mean, I think we're hearing people talk about it more, but are you actually seeing more more lenders like considering non-QM as part of their business strategy? Because we're hearing it, but I don't know if that means that people are implementing it necessarily.
yeah, I do because we get new customers every day, right? That are delivering both broker business as well as correspondent. I think the thing that I'm seeing right now is that we actually have some Dell partners that want to flip to non-Dell. So while they may be delivering other aggregator business delegated because they feel really
Mhm.
comfortable with that, I do think the market is getting hot around having to maintain and keep non-QM underwriters happy because it's just a different ballgame. You know, you're talking about an exception based an exception that products that are solely reliable on common sense underwriting and exceptions, right? And that goes with credit rate and grading a loan. So I do think that there's a couple reasons why people are looking more to non-QM is that flexibility, but I even see where people are relying on it more that when they were doing the onesie and twosie loans, they might have been comfortable with that. But now that they're having to fit all these borrowers right into a new box, they're not ready to support that type of volume. And so they're looking for
Yeah.
folks like Logan to come in and help provide those options for them. And we even have, I mean, interestingly enough, we actually have, some credit unions and some banks that do things with us, which are those old portfolio products, right? So I
Yeah.
do think non-QM is something that people are looking at for sure as an alternative lending source.
Um, Speaking of credit, let's talk just a little bit about credit. It's been talked about a lot. It's been talked about for quite a while, actually. We went back to, I can't remember exactly how long ago. It was quite a while ago though, where we were talking about tri-merge to bi-merge, and now it's like single credit pull. Um, and obviously, when we were talking about it from tri-merge to bi-merge, even there were a lot of barriers in process and how you would implement that. So, you've been around the industry for quite a while. And what do you think if we would go down to that single credit pull with people over 700 credit scores? What do you think the biggest barriers to implementing a big change like that are?
One, I think you should take a good hard look at what you've been doing, right? And if you put that cap at 700, what does that do to the rest of your loan volume and how much volume would you potentially lose on an exception basis because you're making a black and white decision to not support that borrower at a 690? Or whatever the case may be. So I think one, you have to look at your overall risk appetite, and if 700 is your cap, then 700 is your cap. But I do think it could potentially cost you some business, but it could help your bottom line in lowering your expenses. So it's kind of
Yeah.
like a catch 22. You gotta make sure that you're looking at it holistically and not just from an expense standpoint. I do think a lot of folks. I mean, we've been talking about this too. I'm not interested in us going down to a one credit score, but we have been talking about going into a buy merge situation and kind of looking at what those options are. Everyone on this call should already kind of know what bureaus they want to pull specifically between the three main ones, Equifax, Experian, and TransUnion, because you get to choose. Usually with your credit provider, you get to choose which three or which two of the three or which one of the three you want to pull in. So that's why I just say, like, make sure you're taking a look at your pipeline because while those decisions might improve your bottom line, you could be leaving deals on the table. I get a little nervous about, hey, if you have products that go down to 660, then I think at a minimum you should be looking at 660. But we also make exceptions. So we're an exception-based business. You may not be. So again, I think everybody's answer is going to be a little bit different on this topic, but I get a little bit worried about fair lending and making sure that they're getting a fair shot at credit because sometimes you can't get a clear picture without the three because that's what the end investor is going to require, right? They are somehow going to securitize that loan later down the road. And while you may feel comfortable with one or two, at the end of the day, you're going to need three to sell it. So,
Yeah.
and then don't even get me
Yeah.
started on the Vantage score and all that. I don't even want to go down that.
Don't want to go down that path on a
No,
Friday.
I need a lot
So
more than coffee to talk about
exactly. Exactly. I just have coffee in mine too.
that.
Exactly. Um, do you think, by doing that, so you think if people had business below 700, do you think that means that people would be doing some sort of bifurcated process? Or if people would just like draw the line and say, we're working at 700 and above, period.
I've heard both. I mean, feedback on that. I mean, I do reach out to my peer group when I try to make big girl decisions like that sometimes, and want to know, like, hey, what are you doing? How's this affected your business? What are some things that maybe I can learn, or or what can I teach you based off what we've done? But I could see it both ways. Again, I think that answer is open to how you run your business because at the end of the day, if you're
Yeah.
trying to lower expense, having a bifurcated process and a linear workflow can cost you as much, if not more money than what you're saving in the pool itself. So I
Yeah.
think when you're thinking about it from a business aspect, everybody is different here on this call and how you run your business. So it's hard for me to give like an answer that's right for everyone. But I
Oh,
know that
yeah.
while we're thinking about by merge, we're looking at the overall process, not just the ability to save in credit pool costs. Because let's face it, credit's gone up over 100% in cost over the last couple of years. So
Yeah.
actually, I think it's probably more than 200% at this point, but don't quote me on
And we won't go there on a
that.
Friday. We'll flip over to a new topic of conversation. So, housing affordability. Obviously, there's just a huge number of factors affecting housing affordability. One of the things I came across this week, which was just interesting to even think about, and it's something that definitely has impacted me personally, but nearly half of homes on the market today have an HOA cost. That was really surprising to me. Now, I live in a townhome, so very common. You don't think about
Mhm.
that. But out there in the world, there's a lot of, different housing developments that have HOAs that are standard single family dwellings. My housing, my HOA went up to 800 or $587 a month. And it's because of the cost of insurance. And that's the primary reason why it
Yeah.
went up. But of course, everything has gone up in the world that we reside in today. So, what do you think? I mean, obviously, not one thing is going to fix the what we've got going on with affordability. Zoning reform is something that I think has gained traction in some places where you can do more multifamily than you've been able to before. But what do you think would make the biggest difference from a solution for the industry, like as a whole, related to housing affordability, knowing that not one thing is gonna fix everything?
Yeah, I mean, I can tell you, like, I've personally been affected as well. And I kind of hold true my comment earlier, a house you could afford 5 years ago, you're struggling to pay
Same place, yeah.
and I'm being vulnerable in this sense because, I have a great position, I have a great job, but think about all these consumers that are trying to get in homes or they've been in homes for a while and the market has changed and rates have come down a little bit, but rates are not the only game here. And the other
Absolutely
expenses like
not.
your HOA.
Yeah.
I mean, again, I'm sharing a little bit of personal information here, but my insurance doubled, which I had to shop and get it back down, which is fine. It's just more work for me to have to do. But it's you're kind of bleeding from every sense of the imagination. Because you get these people in these homes and yes, they're other expenses that are going on, but like energy costs have gone up. I'm, personally, again, I'm fighting with an energy company right now about trying to take away farm taps that and moving us to electricity, and that's 3 times more in cost, right? So these big business decisions are being made and affecting consumers in ways that you can hardly imagine. You asked me specifically, what do I think we could do? I mean, there's so much that can be done at the federal level, at the state level, even at the HOA level. I can tell you right now, my HOA goes up, and I don't know what's different other than the insurance piece because I don't get more Christmas lights, and I actually get probably more letters in my box now than I ever did. So it's paying the mole in the community to go around and tell me my grass is too high. Maybe I don't know. But you're right. I don't mean to laugh about it, but sometimes you have to laugh about these things. Um, but I do,
Yeah.
rates will help, right? But I think largely, inflation was at an all-time high. It has come down. I think somewhere, I don't know, I think it's just shy of 3%. I think inflation's come down. So that's a good thing because that's, groceries have gone up, gas has gone up, everything's gone up. So it's good that it's gone down, but compared to 2020, it's up overall. Like I think it's still up like 25% or somewhere around that. So comparing yourself from a 2020 to 2026, you're talking about a 6-year gap, and things have raised pretty significantly. And even though that they're coming down a little bit, um, it's not enough. And so I'm not going to get into my specific beliefs or politics, but I just think that there's more that can be done outside of just lowering rates. I don't know if we're going to get into a lot of this today, but like I'm not seeing on my business side where we're getting a lot of risk with CFPB, like the states taking over some of those things. Like because again, part of what you charge for a mortgage, right, to do a mortgage, like your risk appetite drives what those costs are. What products are you offering? At what rates you're offering them at? To what types of borrowers? And so when you think about all the costs that we have to take in, right, you have to pay for those costs somehow, some way. Um, so again, rates are part of it, but I also think inflation and getting things right sized in the country itself is probably an important part of it. I don't know that there's anything we can do about insurance, but that's a big factor. And it's not just homeowners insurance. It's like you said, it's the overall umbrella policies on condos, and I mean we're seeing that in states like Florida and whatever go through major changes because of the environment they're in. There's a lot of people and vendors that are providing geostatistics now to say that are providing insurance companies with data to say, you know, hey, this house is like 5% more likely to be hit by a tornado than one in this neighborhood. And all that's kind of happening behind the scenes. So while data can be very good, it could also be very scary and help drive up cost for people. So, you know, there on one hand, you want to know, like, oh God, I probably shouldn't buy this house if it's going to be hit by a tornado. But if I choose to buy it and take the risk, I'm going to pay for it, right? So I think just like anything in our industry, risk equals more money. So
Yeah. Everything here has gone up. I mean, and I'm in Minnesota, so it's not like I'm coastal or anything nice like that. We're just cold. But everything here literally has gone up. And it was our balloon policy. That is what affected our HOA going up so much. And I think that, what from what I've seen, I think insurance is one of those big drivers because you could get into a house one day, and then mine has doubled since I've been here, and I've been here 3 years as of next week. And my insurance has doubled in a 3 year time frame. And so, yeah, so it is very interesting to sit back and see that happen and pray every day for something to change, right? And not everything be going up. So I get that. If you had like, have you seen in Texas? Because I feel like Texas is ahead in some of the housing lobbying efforts and things like that. Have you seen anything where you live that are helping, that programs that are actually helping with affordability that are local to you?
I mean, not personally, I haven't seen anything that hits it. Again, like the business I do, we're again, I lose a little bit of touch with, first time home buyer programs and things like that. What I can tell you is the cost of building new construction. So where I live specifically, which is north of Dallas, you're basically seeing farmland flip to suburban areas, and so there's a lot of building going on. And um, I actually see the opposite, where builders are, starting to build in these hard costs and fees and all this kind of stuff, and making new construction almost really hard to get. You know, uh, Back in the day, if you went to a kind of like rural, semi-suburban, that was where you're going to get the most affordable housing. Not
Yeah.
anymore. You come up here, you're going to get $1 million houses or more than a million. I mean, mine's not a million, but you're going to get more of these types of kind of retreat like homes versus affordable housing. Like, so again, like when you asked earlier, like what can be done, I don't know that this is federally charged or state charged, but community wise, bringing in builders, like, should we be building homes that are affordable versus these $1 million plus mansions? And especially in communities where you're taking over farmland. And again, this would be a nice debate, Faith, actually, for TMC to have, because it's true, right? You're going to you're going to buy all these farmers out, and you're going to put up $1 million houses. Well, none of them can afford to live in them because they're too expensive. So, but
It's like
again, you have,
gentrification of a neighborhood in a way, only it's farmland. I live in exactly the same situation. So I'm in suburbia, and I'm right on the cusp of everything that is being built. And I often sit back and watch it and think, who is buying? Who's buying these places? And how are they buying these places? Because the
yeah,
cost
some
is
of it is
crazy.
what we're seeing here is some of it is transplants, right? It's
Yeah,
people
for
that
sure
a
in our
million
market.
dollar home and a hut in another state, where here you're getting a 5,000 square foot home for a million, right?
Yes.
So, or more, So again, I think some of it is trying to accommodate people moving into the state because Texas is a go-to state for tax
Yes.
purposes, especially on the business side. There's no state tax here for consumers or for like residents of Texas. So I do think there's a lot of bonuses to being there, but yeah, that's what we're seeing, and at least what I'm
Yeah.
seeing in Texas.
Yeah. Well, in the last month, probably not a lot of people are moving from outside the state into Minnesota, but we do definitely have an influx. And maybe people are moving because they're
Mhm.
seeing the great community that we have here related to what's going on in the environment out there. But yeah, seeing the same things, very similar things here, higher costs. Our builders are the one place though here that they are, they're doing some buy downs and things like that for people, trying to get more people
Mhm.
into those houses. But the actual cost of the house just amazes me that you can't buy a townhome in the community that I live in under 450. And it wasn't that long ago that you were talking in the upper twos probably, and now it's in the upper fours. So yeah, so there is that going on here as well. I can't believe it, but we're almost at the bottom of the hour. And I wanted to give you a shout out, just so that everybody on this call knows that Sarah has run our advocacy committee here within TMC for the last year. So she's heavily involved in some of those things related to us organizing our membership, and has moved on now as of the first of the year to become the chair of our lender member board. So I just wanted to give you that shout out and thank you for everything that you do for the industry and within our TMC family. It's really greatly appreciated. I cannot wait to see you. We're in Scottsdale in just a couple of weeks, and I cannot wait to see you. This has been really the nicest conversation today. I always appreciate it when you take time to come on with me. So thank you for sharing everything with our TMC family and those who joined. Come back in a couple of weeks. We will be back here for the latest in mortgage today. And at that point, we'll be sharing some things. It'll be right after conference. We'll be sharing some things related to what we saw at our conference in Scottsdale and really look forward to that. So thank you, Sarah. We
Thank
appreciate you
you
a
for
lot.
having me. Thank you everyone for joining. See you in Scottsdale.
Yeah, have a great
All right.
weekend, everybody. We'll see you in
All
a
right.
couple weeks.
Bye.
Bye.